Chapter 6, Inventories. Merchandising companies that buy the inventory ready to sell have one classification of inventory titled merchandise inventory. Manufacturing companies have three classifications of inventory: raw materials, work in process that consists of partially completed products, and finished goods that are ready to be sold to the customers. All inventories are reported under the current assets section of the balance sheet. There are different methods of accounting for the inventory costing. Specific identification tracks each item of inventory separately. First in, first out, or FIFO, assumes the inventory units purchased first, or the earliest, are sold first. Last in, first out, or LIFO, assumes that the latest or most recent goods purchased are the first to be sold. The average cost method calculates a weighted average unit cost and assumes goods are similar in nature. The illustration shows the use of the various inventory costing methods. The cost flow assumption does not need to equal the actual physical movement of goods. For example, grocery stores may use the LIFO method for accounting purposes, even though the oldest merchandise is sold first to the customers. Companies maintain consistency between the years of the inventory methods they use. That is, they do not switch back and forth between the methods. The perpetual inventory system presented in Appendix 6A will be emphasized in this accounting course. The following data for Houston Electronics will be used to compute cost of goods sold and ending inventory under the FIFO, LIFO, and average cost methods. The first line shows beginning inventory. On April 15th, August 24th, and November 27th, the company purchased inventory, and on September 10th, the company sold inventory. The cost of the inventory is recorded in this column. For example, the beginning inventory on January 1 consists of 100 units that each cost $10 for a total cost of $1,000. The unit costs reflect inflation, with the unit cost increasing over the year. The last column reflects the inventory balance in units as of each date. For example, the inventory as of September 10th is 50 units, calculated as 600 on August 24th minus the 550 units sold on September 10th. Assuming use of the perpetual inventory system, on the following slides the cost of goods sold and ending inventory will be presented under the FIFO, LIFO, and average cost methods. The first method presented is the first in, first out, or FIFO method. First in, first out, or FIFO, assumes the inventory units purchased first, or the earliest, are sold first. FIFO often parallels the actual physical movement for the merchandise, as companies usually want to sell their earliest inventory first, particularly when the goods are perishable. For example, grocery stores want to sell their oldest dairy products first before they spoil. The first column presents the dates of the transactions. Purchases are entered into this column of the worksheet. Transactions that involve sales are entered into this column. And the final column of the worksheet reflects the inventory balance both in terms of units and cost. On January 1, the inventory consists of 100 units at a cost of $10 each for a total cost of $1,000. On April 15th, the purchase of 200 units at $11 per unit for a total of $2,200 is included in the purchases column. The inventory balance after this purchase now consists of 100 units at $10 each and 200 units at $11 each for a total cost of $3,200. On August 24th, after the purchase of 300 units at $12 each has been recorded, the inventory balance now consists of 3 layers of inventory: 100 units at $10 each, 200 units at $11 each, and 300 units at $12 each for a total of $6,800. Under FIFO, first in, first out, the 550 units sold will first come from the oldest inventory, the 100 units at $10 each. By marking through the 100 units, it signals the units are gone. The next oldest inventory sold is the 200 units at $11 each, crossing those out to signal that those also have been sold. Now 300 of the 550 units sold have been accounted for. The remaining 250 units come from the 300 units at $12 each. The total cost of the 550 units sold is $6,200. The inventory balance on September 10th after the sale of the 550 units is 50 units at $12 each for a total cost of $600. The final transaction on November 27th is a purchase of 400 units at $13 each. The inventory balance after recording the November 27th purchase now consists of the 50 units at $12 each and 400 units at $13 each for a total of $5,800. The cost of goods sold during the year is determined by adding up all the amounts in the cost of goods sold column, which is $6,200. The ending inventory is the latest inventory in the last column of $5,800. Last in, first out, or LIFO, assumes the latest goods purchased are the first to be sold. LIFO seldom coincides with the actual physical flow, with the exceptions being goods stored in pits or piles, such as hay or rock. The worksheet for the LIFO example will be the same as FIFO up until the sale on September 10th of the 550 units. The inventory that is available to be sold is comprised of the following inventory. LIFO assumes the latest goods purchased are the first to be sold. Therefore, the sale will first consist of the 300 units at $12 each. Marking through the units signifies the units have been sold. Next, the 200 units are sold and marked through. Now 500 of the 550 units sold have been accounted for. The remaining 50 units comes from the layer of 100 units at $10 each. The total cost of goods sold recorded on September 10th is $6,300. The September 10 inventory after the sale is 50 units at $10 each. After the final transaction on November 27th, the inventory balance consists of 50 units at $10 and 400 units at $13 each for a total ending inventory balance of $5,700. The total cost of goods sold is calculated by adding up the amounts in the cost of goods sold column. The average cost inventory costing method calculates a weighted average unit cost. This method assumes the inventory goods are similar in nature and applies a weighted average unit cost to determine the cost of the ending inventory. The worksheet reflects the beginning inventory balance on January 1 of 100 units at $10 each for a total cost of $1,000. On April 15th, after the 200 units are purchased, an average cost per unit is calculated. The average cost per unit is calculated by dividing total cost of the inventory by total units of the inventory. The average cost of $10.667 is calculated by dividing the cost of 1,000 from January 1 plus 2,200 from the April 15 purchase by the 100 units from the January 1 plus the 200 units from the April 15 purchase. After the August 24 purchase, a new average cost of $11.333 is calculated by dividing total cost of 3,200 plus 3,600 by 300 units plus the 300 units from the purchase. Check the average cost per unit for reasonableness. The average cost per unit before the purchase was $10.667, and the purchase was made at $12 per unit. Therefore, the new average cost per unit should increase from the $10.667, but not be greater than $12 per unit. The September 10 sale of 550 units is recorded at the average cost of $11.333 for a total cost of goods sold of $6,233. After the purchase on November 27, a new average unit cost of $12.815 is calculated. A new average cost per unit is calculated after each purchase. The cost of goods sold is determined by adding the amounts in the cost of goods sold column. The ending inventory consists of 450 units and an average cost per unit of $12.816 for a total ending inventory of $5,767.